Good afternoon, everyone. Welcome to another Wednesday webinar. I apologize for the slightly slow start. GoToMeeting was a little delayed, but we're ready, good to go, and ready to start. I'm glad to see we have a good number of people in here. My name is Stock Darts. As usual, we're going to go ahead and cover the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish with that, we will then move on to looking at the U.S. dollar real quick, seeing how it's faring versus gold, silver, and oil, and then we'll go to the chart requests. If anybody here has a chart request, you can already put it into the chat. That way I get an idea of how many I need to look at once we go ahead and finish covering the markets. Other than that, let's go ahead and get started. As always, you can find me on Twitter or YouTube under the name Stock Darts, or you can go visit patreon.com/stockdarts and find some more content from me, such as some trade ideas that I have during the weeks, and sometimes just trade ideas and stuff I put on my watch list. Other than that, let's go ahead and get started with a look at the S&P 500. And as we can see, the market's done really well this week, right? So last week we were discussing the potential for a market drop / correction, and we got one, and it was, for the moment, or at least the time being, very short-lived. You can see we finally broke that uptrend. It was something that was due for a while, right? We were getting slow. The momentum was slowing down, and you can see we had volume declining up to what we just recently saw. And this typically happens, right? When you have, oh my. All right, typically when you have price rising like this and volume declining, sooner or later you'll get a drop, and typically when that drop comes, it's accompanied by a little bit of a bump in volume, and that's exactly what happened. Now, surprisingly, we had an immediate bounce, right? And this was part of the discussion we had last week as well, right? About, even though I'm expecting the market to drop, why I'm not interested in shorting it. Why I think that it's a better idea to just wait and buy the dip or continue to look at long trades is because when there's this much demand under the hood, right? When we have a market that continues to just be bought up and gobbled up, it becomes very difficult to take a trade to the short side. And that's exactly what happened to anyone that tried to short this. Is if you didn't close your trade in exactly 2 or 3 days, this thing came all the way right back through whatever your entry was. No matter where you entered, even if you entered at the very, very top, we've already come right back past that, right? So that's why it's so difficult to trade these counter trend trades when a market is this strong. I'm not saying not to trade counter trend. There are times when it's worth it, and certainly time frames. But I think at the moment, for those of us that are looking to swing trade and are looking to take advantage of this market from a daily to weekly sort of time frame or perspective, it's not a good idea right now to try to short this market. I think it's a much better idea to wait for these drops and then have your contingency plans in place on how you want to go ahead and buy it depending on how it bounces. Now, we are at a point right now where, depending on which index you look, we could just be coming back and retesting the breakdown, or we could have passed it, right? When we look at the S&P 500 and we look at the NASDAQ, we're going to see a market that has kind of already eclipsed the previous price action and has sort of moved on to new highs. But when we look at the Dow Jones and we look at IWM, spoiler alert, they have not kind of broken past that level and are actually retesting and sort of look a little bit more bearish. So we got a little bit of a mixed signal right now as far as what to expect from here to next Wednesday. But we'll go ahead and go through all four of the major market indices and see if we can maybe get a clear picture once we kind of cover the four. Now, as far as the S&P 500 is concerned, if we're just looking at SPY, everything it's done is very positive this week, right? You can see we have a clear level of resistance. It's anywhere between about 280.50 and about 280, so maybe like about a 50-cent gap. And we were able to go ahead and breach that again this week. Now, last week we tried to break past it. I didn't think we were ready to do it, and ultimately that move failed and was what eventually brought us that 3 or 4 day correction. Now we're right back up to it, and I still feel like personally we need to spend more time around this area, but we may not get more time. And the reason for that is we already had a drop. We had a shakeout that got rid of a lot of the weaker hands, and that supply was immediately bought up, and we immediately kind of came right back up. We didn't stall, other than that one day. We just kind of busted right through today. And so unless we roll over today into the close or tomorrow, and just kind of give back this 280 level, it looks like the market's ready to sort of push past this level and start testing maybe all the way up to 286. Now again, that's what we're seeing on the S&P 500. That's not necessarily what we're seeing across the board. But if we were just looking at SPY in a vacuum, then today's candle is a pretty bullish indicator that the market wants to push past 280 and wants to start exploring even higher. Now again, that's pretty impressive. And that's, to tell you the truth, a little bit scary because just 2 or 3 months ago, we were at new lows and really looked like we had maybe found a market top. There was a lot of media that was already basically saying we're in a bear market, and of course some people consider a bear market anytime you're under the 200 period moving average. But I think depending on your time frame, if we go back to a weekly chart, there was reason to be concerned once we lost that 260 level and we started to really probe backwards. Now we still had a lot of ground that we needed to really cover before I'd really would have been overly worried about what kind of economic situation we're in. Because again, take a look at what we've done over the last 6, 7, 8, 9, 10 years, and we were due for a bit of a pullback. We were due for some retracement, but the amazing thing is how quickly we've kind of come right back up and are starting to really have our targets set on all-time highs again. And I think that's the issue, is that I feel like it's gotten there pretty quickly. Now, I'm not one of these guys that's going to tell you, well, this got here too fast, so we need to short this, or it's a market top, or anything along those lines. I think number one thing we have to do as traders is respect the price action and follow the price action, not go ahead and try to go against it. So if we're ready to come back to highs, well then any of my personal biases about whether I think we are or not ready for it aren't going to come into play. Is it just Ray, or is anyone else having trouble with the audio? Well, you can hear me fine? All right, Ray, it looks like it's just you. And so, I'm not going to let any of my own opinions of whether I think the market should be at highs or not get in the way. And I don't think you should either, right? There's a place for theory. There's a place for trying to, conjecture and trying to figure out or predict what the market's going to do. But it shouldn't impact your trading. We all have ideas of what we think a market or a stock should do, but all that should do is give you an idea of what you think is going to happen, and then from there you sort of put a plan in place as to what you would do if that sort of scenario played out, right? And so you don't actually say, well, I think the market is too high, so I'm going to short it. You tell yourself, well, the market looks like it's too high. What would it need to do for me to want to short it, right? And that's how you would have to approach it. And again, I don't think shorting is a good idea right now, but I'm just sort of giving you the idea of how you should approach trying to trade, whether it's to the short or the long side, whether you have this idea that the market's too high or too low. And for me, if the market wants to go higher, then the market wants to go higher. And all I can do is go ahead and take advantage of that momentum and trade to the long side, which is what I keep telling you guys, is sort of ignore any real reason, ignore any of these sort of reasons that you see on the news telling you what you think should or shouldn't happen because the economy is this or the economy is that. The market doesn't necessarily always care about what our economy is doing, at least not in the short term. And so you need to just respect the price action and follow it, right? And so if it's ready to push past 280, well, then I'm going to look at 286 as the next level it wants to get to and see what happens from there. Now, that being said, we're not totally out of the woods yet. Yes, we peaked over right now, and we're holding above it. But we started to get above it last week, and that was on. Well, it was 2 weeks ago already, I guess, on the 4th, right? No, that was last week, last Monday, right? And so last Monday we started to get above it, and we ultimately kind of came back and gave it back up. And there's always a chance that we sort of spend a few days around this level and then roll right back over. And it doesn't look like that on the S&P 500, but it will look like that in a couple of the charts we're going to see afterwards. So for now, I think we still need to sort of watch to see what happens with the price action. But I will say that this is pretty bullish, what we're seeing on the S&P 500 and we're seeing on the NASDAQ. and those should be areas that we should look at as far as going ahead and trading to the long side. And again, I'm still advocating trading to the long side, not trying to short this market. And I think the right approach right now, again, is either wait for a bull flag here and trade that to the long side, or if we do pull back, wait for the next setup and then go ahead and take advantage of these big bounces that we're going to get if these buyers continue to step in and try to push this market upwards. Now, what are the levels we can look at, right? So I pointed out the levels above us, right? So 286, and then if we get past 286, well, all-time highs around the mid, 290, 292, 293 is the next level. But if we do pull back, well, I think it's pretty clear. We just established a new level to watch, right? Which is somewhere around 272 to 273. If we pull back and fall below that level, then we probably head down and test the 50-period moving average, and maybe come halfway between that and this 263 level. So maybe somewhere around this 268, 267. But I don't think we do that. I think we do pull back. We probably retest 273 and then maybe establish a broader consolidation range in that area. Maybe do something like this. Now, if we did pull back, that would be a slightly more bearish sort of sign, because again, it would show that we are dropping back below our breakdown point and retesting this area. And again, if we did lose that area, well, then we can probably expect to move back down at least a few more points, but not necessarily all the way to the bottom of the range. And this actually mimics a pattern that we've been seeing in this market the last couple of days, and we're actually seeing even at the moment, right? So if you take a look at what happened yesterday, for instance, we had a nice ascending trend, and eventually we broke down and we kind of traded sideways and then eventually broke down further. And it's a pattern that I've described on a number of occasions. And we're not seeing quite the same thing on the S&P 500, but it's a pattern that happens often, right? You have a breakdown, you come down, retest it, they come up, and then it's that retest that's real critical, whether you turn around and head lower or whether you push past it. Now, it does push past it on occasion. It did that. Did that on Monday, right, where we broke down, and then on the retest, it just continued to climb right back through. So it's not necessarily etched in stone that if once you lose an ascending trend line on a breakdown, then when you come up and retest it, it automatically becomes a spot to short. But it is something to watch and see how it behaves as that pattern develops, right? And that's a pattern that develops very often, particularly in a trending market like the one we have right now. And like I said, for the moment, we actually have already pushed past it, right? So at this point, you would almost say that this is sort of a false breakdown, ready to move higher. But again, this could be a false breakout through that level. We just have to see how it reacts to this price area around 280. And again, I expect a lot of supply here. I think that this is a pretty big area for the market to clear. We've done an incredible job so far this year to get to this point. And like I said, it looks like this S&P 500 wants to push past it, but I feel like there's more work to be done for it to really get past it. And today's candle, while it's a real nice development, I don't know that it's enough yet to convince me that we are ready to go ahead and start making our way back up to 86. But if we do, I'll be ready for it, and I'll have trades looking to take advantage of that momentum. Now, if we look at the NASDAQ's even stronger. And you'll notice, if you guys remember last week, I mentioned the NASDAQ is one of the areas you want to look at buying strength. It's been, relatively speaking, one of the stronger indices, and has, as you can see, cleared last week's highs pretty decisively and is making its way up to 178. This is another key area of resistance, and I would anticipate that it becomes an area that we struggle to push past. Again, like I mentioned with the S&P 500, we've reached the spot where pushing past this next level basically puts all-time highs in sight, right? And so the real question is, do we think the market is ready to push past last year's highs and to move on to new ones, right? Well, at the very least, to revisit the highs, right? It's get ahead of myself to say push to new highs, because again, there's a long way to go just to test those highs, but it would still be pretty incredible from the lows of last year and how we started this year to think that within 3 months, basically 1 quarter, we're already right back to previous highs, right? So a lot of work to be done still, and I think 178 is going to be a key area that the Nasdaq needs to push past. And I would ultimately expect us to stall out at that level. Now, whether we stall out and print a flag and then push past it is anyone's guess. Because we've already had a breakdown and immediately bought it back up, we have sort of a new impetus or new momentum in the market, new upwards momentum. So there is the possibility that we've already had enough of an exchange between weaker hands and stronger hands, or buyers that bought a long time ago and the new ones that just stepped in that are ready to hold this to push past this key level, right? So I would say the Nasdaq is the most bullish of the charts that we are watching, but with that being said, there is potential resistance right ahead of us, and there's a chance that we've already had the bounce that we needed to sort of realign ourselves back on a bullish stance. And now comes the next step, which will be a consolidation of this 4-day bounce and see what happens once we approach 78. Now, that being said, we have a little bit more to go, so there's always a chance that we close strong today or maybe even open up strong tomorrow, and then we start to see whether there's some selling pressure that's going to come in and affect or impact the markets. But for now, things are looking pretty good here as well. Now, if we have to analyze all our key levels, I would say clearly 178, as I've been sort of harping on, is a very strong level of resistance. If we could push past that, then we probably take a pit stop at 182. But I'd say if we get past 180 or 178, it's a pretty good chance that we attempt to reach our all-time highs. Now, if we falter here, then I think it's pretty obvious. We could kind of come right back down and retest this area on 171 or slightly below it. We got the 200 period moving average. We got the 20 period moving average. We've got this horizontal level, and we've got the lows from just last week right here around 170, 169. So that obviously is a pretty obvious area to expect us to pull back and find some support. Much like what I mentioned with the SPY, I think if we do pull back there, we probably find support and probably attempt to bounce again from there. And then maybe a third test of this would be where we would finally start to break below it. But I don't think our next test would push us back below it. I think it would be another area where we'd find another bounce on it. Now, if we did fall below there, then the next key area is 166 to 166 and slightly below it, around this breakout area from this channel that we spent most of the last 3 months of last year in. If we fell below there, then I'd maybe be a little bit worried. Judging by what we're seeing now, I don't expect us to fall below that area anytime soon. And that would be the last sort of line, I think, where I would be very quick to buy bounces. If we fell below there, not saying I wouldn't buy the bounce or buy the dip, but I would be a little bit more leery of it because we would have fallen below a pretty key area, and there'd be a little bit further to drop before we really started to figure out exactly where the buyers are going to step in. But again, I don't think that's in the cards right now. I think what I would expect is either we set up a flag here and then try to break past this key level, or if we do pull back, then what we would be doing is very similar to the S&P 500. We'd be sort of establishing a broader base between maybe 170 and about 178. And I think this makes more sense to me, logically speaking, of what we can expect out of the markets, or what I would expect based off of the levels that we are at and what I would expect. But again, that's just my idea. The market could have a completely different idea. And if a lot of traders like myself don't think that the market's ready to push past 178, well then, surprise, the market's probably going to push past 178 because that's what it likes to do. It's going to go in the direction that has the least resistance, and if no one expects it to go there, then it's going to probably push through there and explore and try to figure out exactly where people will go ahead and step up and make a decisive stance on whether it's too expensive or too cheap, right? That's how it always goes. That's how it always goes back and forth. Is it's trying to figure out where people will make that decision. And so we'll see what happens, and whether 178 is that key area, or whether it's going to need to be somewhere around 182, or even all the way up to 187. But those are the key levels for the Nasdaq. And again, if you're looking at names to trade, the Qs and the tech sector in general are one of the areas that's behaving very well. Another area that's behaving well is one of your chart requests, Denise. We will take a look at Kronos and some of these other weed names or marijuana names and see that they are actually, there's quite a few of them that are actually doing pretty well. But as far as the major indices, I think tech is still one of the areas you want to get involved in. Now, in contrast to what we just saw in the S&P 500 and the NASDAQ, we look at the Dow Jones, and we're in a different place, definitely in a different place, right? So, as you can see, I'm going to go ahead and draw a couple trend lines that we didn't have. All right. As you can see, we broke down last week, and we haven't really recovered past that level. As a matter of fact, this is more of a classic short setup that you want to see, right? Which is you have a trend higher, you get a breakdown, and then you come up, and once you get to that point, that breakdown point, you start to stall out. And then from there, you could turn around and play it back down to its previous lows and possibly below it. Now, that being said, while I think this is a classic short pattern, I would not short the Dow Jones, just like I wouldn't short any of the other market indices, because again, the strength that we've seen in this market is going to make that a difficult trade. And that's a concept we discussed a little bit last week, but I want to go ahead and elaborate a little bit on it right now, particularly because Ray is in here again, and he was going to probably ask me about his short play on the NASDAQ again. And what I want to point out here is that when you're trying to trade, you're trying to protect not only your capital, but your emotional capital, your emotions, your psyche. And when you have a market as strong as the one we're in, what ends up happening is it keeps getting bought up as soon as you have 2 or 3 days to the downside, right? And it makes it a very difficult trade because, again, you have stuff like this that happens where it shoots right past your entry point, and yeah, maybe you were able to take some profit off of part of that move. It moves so quickly though that if you don't have perfect timing, and I mean absolutely perfect timing, then you get penalized, and the market just goes ahead and just moves past it and makes you doubt your trade. And even if in the end you get the trade that you wanted, it's an unnecessarily difficult trade, and it's a trade that becomes extremely hard to manage, both from the perspective of money and from the perspective of your sort of psychological well-being, as far as being able to have confidence in the trade. Okay, and so right now the Dow Jones, I will say, looks like it wants to head lower compared to what we're seeing on the S&P 500 and the NASDAQ. That being said, I would be looking at that as a move that I would anticipate buying once it did drop, not necessarily trying to short this quick move. From 258 maybe back down to 252. It may or may not happen. It could be the case that the Dow Jones and IWM both decide to follow the S&P 500 and the NASDAQ higher. And that's the part of the problem we have right now, is we don't know which of these four indices is going to ultimately be the one that pulls the others with it. Either the S&P 500 and the NASDAQ continue higher, and the Dow Jones and the Russell 2000 have no choice but to follow it higher, or these guys stall out and roll over and then sort of take the S&P 500 and the NASDAQ with it. So that's why, I think it's mixed right now. And more than anything, I think I'm just going ahead and taking shots at trades that are giving different patterns that I think are worth playing. We'll get to that question once we get to the chart request, Ray. All right, now, as far as the key levels with the Dow Jones, obviously 258 is a pretty critical level. It's 258.67 or 258.50, whatever you want to call it. If we can get past that, well then I think it's a pretty quick run right back up to the previous highs around 261. You'll notice the Dow Jones, if we do push past that, we're already pushing up to all-time highs, right? So not necessarily that concerning that we're a little bit weak in the short term on the Dow Jones, because in the intermediate term it was so strong that getting back to those levels would be a signal that we're ready to push to all-time highs. And it's funny how these things sort of recalibrate, where the one that was stronger 2 weeks ago pulls back now to let the others test the levels above them and not really push to the next key area, right? So the concept I'm trying to explain here is, if you look at what's happening here, right, we're dealing with a critical area where if we push past that area, we're at all-time highs for the most part, right? And you can see the S&P 500 and the NASDAQ, which were weaker just a few months ago, are now dealing with that overhead resistance. The Dow Jones which had already sort of cleared that overhead resistance and was making its way pretty close to all-time highs. Now it's slowed down to give those other two indices time to test their test their critical levels, and so they slowed down so that they don't kind of push ahead and start testing all-time highs. And this happens often, and it's a good thing when you have the markets all pushing to all-time highs together. I think it gives it a little bit more validity, and so it's not that concerning right now if we're stalling out on the Dow Jones, because again, if it were to be pushing ahead, then I think it would be maybe getting ahead of itself and make it harder to trust. So not a big deal here. The question is again, what levels can we look at, and how would we go ahead and approach trading this? And I think as long as we don't lose this key area here around 251 to 250, we're fine, right? We're still below the 20-pair moving average, but we're above the 200. We've got the 50 curling upwards and coming up to meet price, and so the idea is that we can hopefully do the same thing on the Dow Jones as the other two, which is just sort of trading this broad base and sort of spend another couple weeks digesting the price action and getting new buyers to come in as the buyers that bought earlier in the year start to step out and give their shares to new buyers that are looking for higher prices. And that would be, I think, ideal as far as how we can go ahead and approach a move to all-time highs in a more healthy manner rather than in a really stretched out and overbought manner, which I think the drop that we just got and the bounce that we saw in the S&P 500 and the NASDAQ, I feel it's still probably not enough to get a full cycle of selling and buying to get new buyers that are really sort of ready to anticipate a move back to new all-time highs. If we lost this area around 250, then I think that's concerning, because that would put us right back into this below this descending trend line, but more importantly back into this range that we spent sort of the end of last year before we really broke down. But it would show that not only are we now ready to push to new highs, but we might need to kind of come back down and start testing some lower area, right? So you don't really want to see anything below about 251. As long as we stay above these two moving averages in this descending trend line and last week's sort of lows, we're fine. If we start to lose that, then maybe we need to step back and kind of wait and see how things shake out before we really want to go ahead and step in back to the long side. But I still think even if we did drop down to that level, it would still be a dip worth buying. We just would have to be more patient about what kind of pattern we'd want to see before we bought that dip. Now, the last one is IWM. And again, very, very reminiscent to what we just saw in the Dow Jones. We had the range that we were in. We had the ascending trend line. And here's the test of that breakdown, and we're right back up to it. And again, this looks like basically a short trade, or a short trade that I like to take a lot. I'm not going to, only because, again, it's the same thing. The four markets are sort of mixed. We've got two that are above it. And I think there's too much demand to really take advantage of these shorts. But this looks like a short trade. And typically what happens in this scenario is you kind of come back and retest the previous lows, and then either you set up a base or you drop below there. We're below the 20. We're below the 200. And really the 50 is kind of coming up to meet price, the 50-pair moving average, right? And the Russell 2000 has been the weakest index for a while now. And the fact that it's lagging behind isn't that concerning again. It seems like every time that the market drops, the Russell 2000 is the one that drops the most and the quickest. Because again, it leads to this theory I've had anyway, that over the last 10 years, a lot of traders and a lot of institutions have been very distrustful of this market. I constantly get this sort of impression from people that I talk to, especially people that don't really trade the market, where they feel like a lot of what the market has done has been sort of smoke and mirrors, and they feel like it's manipulated higher, and that this isn't real prices, quote unquote, which I of course completely disagree with. I think price action is the only thing you should pay attention to. If you bought IWM at 126 and you sold it at 159, that's real money that goes into your bank account, right? Regardless of what your opinion is on why it went to that level. But because of that impression, a lot of people have had one foot out the door on this market since way back in once we had the 2007-2008 drop. It seems like traders have been very distrustful of this market and have been quick to get out anytime there's a sign of selling. And every time that there's a sign of selling, everyone thinks that it's the end of the world and that this is the return to 2008. And despite the fact that that has not been the case, that has been the price behavior that I've found most consistent. And I think the reflection of that and what has kind of given me that impression the most is IWM and the small caps. Now, the small caps are typically the most volatile assets of the four major market indices, right? Of these, the four that we look at, the S&P 500, the NASDAQ, the Dow Jones, and the Russell 2000. The Russell 2000 has the smaller names, the smaller companies that have the more volatile assets in them, and they tend to move more. Typically in bullish environments, this is where traders go because they're aggressive, they want returns, and they're not worried. They're not scared about the market dropping. In the market that we've been in, even during our strongest bull markets, very often it's been often that the small caps still sort of underparticipate and sort of lag behind. And I think the reason for that has been that traders have been sort of fearful of this, even at its best of times, and have had one foot out the door. And I think that continues to be the case. And it's pretty obvious every time we get a drop, IWM is the first place to go down. So as long as it continues to slow down here, it's not a big issue because, again, it's part of the same psychology that we've seen in place for about 10 years now. And I don't think it's really that big of an issue. Would I be concerned if we lost 150 slightly? I think I'd be more concerned if we lost 145. I don't think that's really in the cards, but that would be the area where I'd be more worried about the small caps compared to the other indices. Now, that being said, if we did lose 150, I think that would probably coincide with the Dow Jones also losing a pretty key level, and with the S&P 500, the NASDAQ dropping back to probably some of the lower areas we're looking at. And then at that point, maybe we'd have to sort of step back and reevaluate and try to figure out what's going on. But that's probably not in the cards yet. I think if we do drop, we're going to go ahead and probably attempt to bounce again at this 150 area. And I think that's a pretty likely scenario. Despite how bullish the S&P 500 and the NASDAQ look, if the Dow Jones and the IWM, if they win out and they pull these two back below them, then there's a pretty good chance that we do end up following that classic short pattern where we top out here 156, we come down and we retest this area around 150, and then becomes the critical point. Do we exceed it, or do we find this area as a good support area and we bounce and start to establish that range that we've been discussing? Something like that, right? And for me, the scenario that I'd like to see the most would be this one. Because for me, that would mean the healthiest price action, and it would give us more chances for more charts to sort of reset and give us longer consolidation patterns that eventually lead to much better risk-reward scenarios. When you have, well, actually the NASDAQ's the best picture of it. When you have a scenario like this is extremely bullish. The truth be told, this is more bullish than the scenario I just pointed out. However, this is not necessarily the easiest scenario to trade, right? Because we've already, if you missed the bounce over the last 2 or 3 days, well, you've already missed it, right? We're right back to where we were last week and beyond that, which is, as far as risk reward is concerned, from a trader's perspective, this is not a great spot to go ahead and buy. It's not a great place to short, and it's not a great place to buy because we've surged forward up in 4 days. We're right back at resistance. There's no real pattern here that dictates that it's a good idea to short, and there's nothing here that really says it's a good idea to buy, right? So for me, I'd prefer that we sort of trade sideways and let some charts take a breather and let them develop patterns that become a little bit easier to trust and a little bit easier to trade. And that's not what we have right now, especially on the NASDAQ and the S&P 500. Now, there are other ways of the market giving us a better trading opportunity, and one of them could be that we just set up a flag like this and trade tight for the next few days in an area, 178 to 176, and then eventually try to push past that. And then that would be an area that maybe where we could get better risk reward on some tradings. But for now, that's not really what we're seeing. And what becomes it becomes a sort of a scenario where we need to wait and see how this develops and see if it gives us a better pattern that gives us better risk reward. Now again, this could be worth shorting if you're really aggressive, but I personally would stay away from it. All right, so that's the four major markets. I think because we have a mixed bag here, right? Obviously, if you look at IWM and you look at the Dow Jones and DIA, they have very different patterns from what we're seeing on the S&P 500 and the NASDAQ. These two, the Dow Jones and the Russell have very bearish, or not very bearish, but bearish patterns, and the S&P 500 and the NASDAQ both have pretty bullish patterns. And you divide the two and you just get neutral, right? And maybe we get some more consolidation. But probably what happens is one of these pairs is going to win out and pull the other one with them, whether it's up or down. And then from there, I think we'll get a better idea of how we want to go ahead and trade and which ones we want to follow. I would recommend if you want to go to the long side, stay with the techs. If you want to trade to the short side, then maybe you want to look at some small caps and maybe mimic the pattern that they're doing. But personally, like I said, I'm waiting to buy the dip. I'm not that excited about trying to short this right now. Even though it could work out, I feel like there's too much demand for these trades to really become easy trades. And that's something I always try to do, is make sure I find the trade that I think is easy to take. All right. Let's look at the US dollar. There has been some pretty big movement in the US dollar over the last week. And you can see we had a huge move, and we've given back a lot of it. But there's been some interesting developments across the currency crosses that we like to look at with the US dollar. This is actually, obviously, if you look at it, it pulled back 4 days. You think, well, maybe it's ready to kind of roll over. But the truth be told, it actually still looks kind of bullish. And it looks like it's just coming back to retest some key areas before it moves forward. It's not that easy to see on the UUP index. If we extend this ascending trend line, really we were rejected at the top of that channel. But we still have plenty of space to kind of pull back and test and still be in a bullish stance on the US dollar. We're at the 20-period moving average, which is a lot of times a good indication of the momentum continue to go higher the way it's kind of curling up. And more importantly, as we look at some of these currency crosses, the euro had a big breakdown versus the US dollar. And even though it's sort of surged right back up to that area, we are now seeing a pretty substantial erosion of price action across this really important price level of 113. Again, we've gone over this for quite a few weeks now. And this area, this 113 is a 113 to 114 is a critical area, and we're seeing the price action slowly drip past there and slowly sort of roll through there. And I think we've reached the point now where we're pretty well established underneath it. And I think if we come back and retest it, the more likely scenarios that we end up kind of heading back down. So that was a pretty big breakthrough for the U.S. dollar versus the euro. And I think at this point, if we can't get back above 113, I think we've now established a new sort of downtrend. And if the U.S. dollar can't break that, if the euro can't break that, I think that this bodes well for the U.S. dollar and for U.S. dollar strength. So that's the key area to watch now. There is a little bit more room to the upside before it heads up into strong resistance. But I think at this point, a move back to 113.76 or to 113.80, somewhere in that area, is a pretty good shorting opportunity for anyone that's bullish on the U.S. dollar or bearish on the euro. If we look at the U.S. dollar versus the Canadian, we have pulled back, and well, again, 4 days in a row down is bearish in the short term. In the intermediate term, we're just retesting this inverse head and shoulders, and often what happens here is you end up finding support and eventually a bounce back to that prior level. So I would say that this is developing into a potential bullish opportunity for the U.S. dollar, although it's not there yet. We do need to see support confirmed, and we need to see a buying pattern in this area. But again, this is bullish to U.S. dollar, and anyone that's bullish on the dollar would look at this as a buying opportunity once the pattern developed. And if we look at the U.S. versus the yen, I think it's the same scenario where it's setting up for a bounce. It is losing a little bit of momentum, but overall, the recent pullback only brought it back to some key price areas. And as long as it doesn't lose this upwards trend, this is also bullish the U.S. dollar. I think this is probably the first area we'd see erosion of price action if the U.S. dollar did weaken. But for now, I don't think that's the case. Other than, I mean, what we're seeing right now. But if this resolved to the upside, it would continue to sort of trade in this channel, make its way higher. So as long as it's in that channel, we have to assume the bullish dollar wants to climb higher. Once it loses this channel, then we can say maybe the U.S. dollar started to tire out versus the yen, and maybe that would eventually affect the other currency crosses. But for now, I would say we've seen weakness from last week to this week in the U.S. dollar, but overall it looks like it's still at support and looking like it wants to bounce in the near future. Now, what that means to me is that gold and silver aren't really at a place where I want to go ahead and play them. They did have a nice bounce over the last week or so, but they're not at a spot that I'd like to go ahead and trade them. They could be shortable at this spot, but I don't think I even want to short them. I think I want to just wait and see how this pattern plays out. But you can see, again, it's the same pattern we were discussing on IWM and DIA, where you have this ascending trend line and you had the breakdown and you've come up and retest it. I'd be more inclined to short these than I would the small caps or any of the market indices. But I think I'd rather just wait and see what happens rather than try to play this, because there's been a lot of fluctuation back and forth on these. And I think overall they're making a positive change in price action in the longer term. And so I think at this point I'd rather just wait until we get a clear signal as to how I'd want to go ahead and play this. You can see the chart's getting kind of sloppy. There's a lot of volatility and there's a lot of back and forth, but there's not a lot of clean direction. And that makes it much more difficult to sort of trade these things. And silver's the same thing. We had that big drop, and then we had the nice bounce when the dollar sort of took a week off. But at this point, it probably wants to head back down. But I don't think it's at a spot where it's clean enough as far as the pattern is concerned to go ahead and trade it. So I'd recommend watching this and not really getting too involved. Now, the interesting one we have is oil. Oil is actually breaking out to the upside. And as I mentioned last week, if you were looking at long trades, I thought oil names and tech names were the two areas you want to look at. And I think both are behaving pretty well. You can see tech obviously exploded as we saw on the Qs. And you can see oil and the oil futures are starting to make their way above 57 to 58. And if that's the case, once we get a decisive break of this level, well, I think we make a run to 60 and possibly all the way up to 62 to 63. And then maybe see what happens there. But again, this is bullish for oil names and any names that sort of take advantage of bullish momentum on oil. So of the three commodities that we like to follow, if you're interested in one of them, it should be oil or oil names. And that should be an area that we can maybe look at for some potential trades. So that covers it as far as oil, gold, silver, the U.S. dollar. And we are ready to move on to the chart requests. If anyone has questions regarding any of this, just feel free to ask, and we can go ahead and double check it. I think long oil is probably a good idea, Ray. I think it's, from what we're seeing here, it looks like a decent play. Now, again, it needs to fully break out, but it looks like it's doing that as we speak. This pattern is this chart's delayed, but I think it's only by 15 minutes. When we look at USO, same general idea, right? We've got to break out, whether you want to draw it that way or whether you want to draw it this way. And it comes down to the risk reward on what you're looking at, right? And whether you find a trade that benefits from this. Now, would I recommend trading USO? Probably not, because USO doesn't have a lot of movement in it, right? If you trade this long, you might get 20 cents or 30 cents before we get to an area where, maybe 50 or 60 cents. So you might want to look at an oil name like Exxon or one of the, I don't know, any of these oil refiners, oil drillers. We'd have to go ahead and drill down and look at the individual part industries and see which ones are moving along with this, but that's how I would do it. All right, so Denise, let's take a look at Kronos. They had a big move off of, I think it was some sort of buy rumor just last week, and they gave back a lot of it, right? And it's still doing very well, right? Now, this space has done pretty well. I think. Wait, what is ALC? Is that it? Aurora. Which one is Aurora? Well, let's just do this. Aurora, ACB. Aurora had a big breakout today, and a few other names have followed with it. And it seems like this entire space is starting to get stronger and getting some bullish momentum to the upside. Kronos has not done so far. Matter of fact, you can see they had a sympathy move up today, and then it failed. And today's candle doesn't look that great, actually. It looks like it maybe is starting to lose momentum, and it might fall outside of this triangle. But you're in a long-term position on this, right? And so I wouldn't do anything with this. I just continue to hold it. I think that there's a lot more potential to the upside on this, and it's not something I'd be that crazy about taking my profit on. I don't think that, I don't even know that I'd sell calls against it. You're in from 13. Okay, so you had a good buy. You got it off of the break of this area. And I believe I think you even had it from before. No, you didn't have it from before. It was from there. But we discussed this even when it was back here, when it was a $6 or $7 trade. And it's a good long-term hold. And I think even if it lost this triangle and came back down and tested 18, I think it'd be fine. It might even set up a buy for traders that haven't gotten a hold of one of these names. And maybe that would be a spot where you could find some support. But I think for right now, it's still pretty bullish. I don't see anything here that would really make me doubt this name. We've got this unsustainable uptrend that eventually broke down, but even that, it really hasn't given up anything from there. And I think at this point, it's not at a spot where I'd be worried yet. Basically, I think that the pattern that we're seeing here, it could end up rolling over, especially the fact that Aurora was up and these guys tried and then failed. But even if it did pull back, I wouldn't expect too much more below 1850. Maybe even if we got to 17, I think it would still be fine. Give me 1 second. All right. So even if it did pull back and came down to maybe 19 or maybe even 18, I think it'd be fine. As long as it's above 1350, I think it's fine. But depending on how it behaved here, I think because you're in a long term, you should just be fine holding it and just let it do its thing. It might need some more time, but even if it did, I think overall this is a very healthy pattern. And again, it's an industry that I think is only going up. So I wouldn't be concerned. That being said, because there's so much buyout potential and there's so many rumors that can make these things shoot up a lot, I don't know that I'd be selling calls on this. I think I'd probably just hold the position and just be fine holding it and not trying to get cute with it, okay? All right. Lana, was it you that... Okay, I'm not sure. You made a question earlier. I didn't pay attention to part of where you brought it up, but you said maybe BA got in the way. Not sure. I missed that. Was I talking about something in particular when you mentioned about Boeing getting in the way? Oh, with the Dow Jones. Yes, you are correct. That probably had something to do with the weakness we saw in the Dow Jones. Because again, the Dow Jones doesn't have that many components, and when one of them gets hit hard, that happens. And it's interesting how that happens, right? Where if the Dow Jones needs to take a pause and then all of a sudden one of the names gets hit, it's kind of funny how these things coincidentally happen. But yeah, that was a big hit, obviously, and yeah, that's actually a very good point. I should have caught that when you first mentioned it. But yeah, that was a pretty big drag on the Dow Jones. So James, and matter of fact, now that I look down, James, you're saying for Boeing, you'd actually like to go long term. So that's a good segue into this. I think when you see these names, these very safe names, get dinged on news, a lot of times they are good buying opportunities. And if we look at it, I think it's at an okay spot to go long term. I think a better spot long term would be the bottom of this area, around 316, but it may not go there. That's a long way to go. And so what I do in this scenario is, depending on how many shares you can buy, right? I'm assuming you're not going to buy 100 shares of this, but if you were going to buy 100 shares, it might be a good idea to sell a put and try to get extra premium on it. But what I would do right now is, when you have a huge move like this on volume, and then you start to get these inside days, there's a good chance that it's going to stay stagnant in that area for the next week or two, and maybe set up some buying opportunities or attempt to start to trade lower. So if you wanted to go ahead and buy this, I think when you are buying long term like this, you don't necessarily have to wait for a total support move, because when you're buying long term, you're buying levels, right? But what I would do in these scenarios is I scale in. I don't like to buy these. If ultimately, let's say I want to own 500 shares of Boeing, I'm not going to buy 500 shares right now. I would maybe look at 100 shares, and then maybe look for some put selling to maybe get assigned more shares as it dropped below there, and then maybe continue to scale in until it got to the price that I wanted, and play that way. Now, the question I have for that is, if you want to go long term, why are you doing it with options since they decay in price? You're just going to buy leaps? Is that the case? Just so that you can have the leverage? Oh, spreads. Okay. Well, in that case, yeah, that's how I would look at it. I try to get some put premium here, and then play it to the long side eventually. Especially when you have these big drops, there's a lot of obviously a lot of IV comes in, and it becomes a better place. But I think the key levels that we want to watch is, we want to watch what happens here around the 365 to 366 area, and then if it ends up going below there, I think there's a lot of room to the downside, but it will be choppy price action, because there's a lot of price action through here. You're gonna get some. 350 is a big round number. Then you get something around the 340 to 330 area, and then ultimately, once we head back down to 318 to 315, then that's a huge floor that should hold. But I think this 360 area is probably going to hold anyways. Okay. All right. Now, Ray, you're still trying to do these. All right. TEUM, Iridium Corporation. All right, Ray. So this looks really good. The question, you're in long from 373. That's a really good entry, Ray. That's a good trade. So yeah, I wouldn't do anything with this. I mean, if you haven't taken profits, take some off, just because it had a huge move to 5, and then there was some selling pressure. But this is looking great. I don't think there's anything wrong with this. This is looking very strong. Huge spike. So there was some big change on this. These guys with their cloud software. When you get a name spiking like this, just take advantage of the momentum. I mean, this thing went from $1 to $5, and there's probably momentum for more. Yeah, I wouldn't. I mean, It's my personal habit when I get in a name like this. I always take partial profits when I get a big move like this, and then let the rest run. I would just let the rest run on this. I don't think this thing is. I mean, this is a huge move, especially off of we had the big move up, and then yesterday looked like a big reversal, but with today's gap up, this thing looks like it wants to head higher. It might take a while, but I don't. There's nothing negative about this chart. Yeah, it could be like tandem. You exited your call, keeping your short put to hopefully recover a loss. All right, so tandem, for anyone that recalls last week, it's a name he loves, but he decided to try to short it by selling calls. I told him it was not a good idea, and as you can see, this is why it's not a good idea on a name this strong. And so, good thing you closed that trade out. I still don't know why you are shorting a put instead of just buying, calls or just buying shares. But the put obviously is going to probably expire worthless. Okay. But you have to keep in mind, Ray, the way you just mentioned that to me, you exited your call, keeping the short put to hopefully recover your loss. Like, you shouldn't look at it like that. You shouldn't look at, well, I'm taking this trade to try to recover whatever I lost. You should take trades that make sense, that you think make sense for a reason, not to try to make money off of a trade that you lost before or something like that. That's typically how traders get themselves into trouble. But thank God you listened and you didn't let this thing, because you would have been in a lot of trouble with a naked call short on this name right now. So I'm glad that you learned. All right. And yes, Ray, I don't think playing this again. Like I mentioned, I'm not going to go over into this into too much detail. This is the inverse of the Nasdaq or of tech, and for all the reasons I pointed out before, I don't think it's a good idea to try to short the Nasdaq right now. So I don't think it's a good idea to go long this. Especially because it's a XXX, or it's a leveraged fund, which, as you can see, lost a huge amount of momentum just off of the last 3 days, and that's why it's so difficult to trade these things. Even if you did get a little bit of profit off of that last move, you can see what happens so quickly, and why it's so hard to take advantage of to play these things, because it has already lost way more ground than it should have for where it's at. Okay. All right. We've got actually a ton of requests today. Actually, Wes, you were first. CLF. You're looking at, okay, so CLF is, well, this is right in line with a lot of the plays that you scanned for. We had the breakdown, and then we have what appears to be a higher pivot. I think it looks fine. I think we need to make sure that this is not a bull flag or bear flag. It's the same advice I give you pretty much on all your names. Might need a couple more days to establish more of a base here, but today's hammer looks decent, and it looks like anything above 10 or so is probably a bullish play, at least to get a bounce back to the 20-pair moving average. And yeah, it's right in that gray area, which I notice happens a lot with that scan, where it's still sort of in a bear flag that could be a V bounce and getting ready for a move back up to retest that breakdown. Okay, but I think it looks okay. It looks like a potential entry coming soon, if not already. But I'd have a hard time with the entry right now because of the risk reward. But it looks okay. And this one looks definitely atypical of the ones that you normally trade. I think okay, so it's at a pretty interesting level here. Something like that, right? And you can see it broke past there, and it's at a point right now where if it comes back and retests and then makes a move higher, then it's a pretty bullish play, because it got above a pretty critical $30 range, and then it should make a move back to 32 and then possibly beyond. So this one probably needs a few more days to set up right. But as long as it stays above 30 or so, I think it's in a pretty good spot. Okay. And sorry guys, I'm going a little quicker. There's actually quite a few today. Ron, you're looking at MED. What would be a buy point? Looks like ready to break out to the upside to you. Okay, so looking at the weekly chart, I want to see some key levels. So this was pretty strong. All right, so it kind of is already there. Now this candle from the end of February is the only real issue, right? Because it already tried to break this area and failed, but it broke out again 2 days ago. And truth be told, this is actually probably worth buying right now. If you wanted to be more careful or more safe about it, I'd watch it trade until it started to really push past this area. But I think it's already. I think the buy was actually 2 days ago. So the fact that it's still at that price point, I think it's okay. I think it's actually fine to buy right now. The risk reward is a little bit skewed because you should have bought it maybe $1 earlier. But I think it's fine here. When you look at the potential, you've got $5 just to test that previous candle, and you've got like another 14, $15 just to test back to this area here around 150. I think it's okay here, and really, as long as it doesn't trade here, I think it's fine. Anything above 132 is fine, as long as it doesn't fall back below this price area. So I actually think it's fine here. Today's candle is not the kind of candle I'd normally buy, but I would have, if I was trying to trade this to the long side, I would have bought it 2 days ago. So the fact that it's still trading the same place is to me. Maybe it's a sign that it's not ready to break out, and maybe it does pull back further. So if you want to be patient, you could wait for another retest of this area around 132 before you buy it. But it would not necessarily be a bad buy now. You're just waiting for the next move up to this, to try to push past that area. But I think it actually looks okay even now. Okay. All right, Ray, this is another one of the cannabis names. It's a penny stock, I guess, 33 cents. Doesn't look that great. Doesn't look terrible. But this looks like a name that, unless you know something specific about it, it looks like one of these is like, well, it's a cannabis name, so I just want to buy it because it's cheaper than the other names. If you're just buying it because it's a cheap marijuana name and you don't know anything about this company, then probably not a good idea. But if there's a reason, if you know something about this company, then you can look at it, right? There's volume that has come in recently. You can see the pattern. It opened up around 50 cents and it's sort of steadily trickled down to 20s, and then now it's kind of trading in this range. As long as it holds at 30, it could be worth buying at 30 and looking for a move back up to the 47, 48 range. But it's pretty low volatility or pretty low volume, so you could get stuck in this if you don't know what you're doing or you trade too much of it. Okay, but yeah, I guess just watch to see how it plays and see if more volume. These kind of names, the volume really spikes when a big institution is getting into them, and that's when you notice their footprints come in, and that's when it becomes a good idea to buy these names. I wouldn't just buy this just because it's cheap. There has to be a legitimate reason for it, okay? All right, James. You want to look at Netflix. All right, so Netflix is one of the tech names that is not necessarily at new highs like the others, but it still looks okay to me. You could tell this is very similar to what we're seeing on the markets in general. We had our sort of trend upwards, and we sort of broke below it, and we're now at the point where we're retesting that breakdown point, and it's a little bullish how it's trying to push and peak past this price point. Now, of course, there's more overhead resistance right above it. So depending on how you look at this, this might not be something you want to trade yet. Because the truth be told, even if it breaks 360 now, it does need to break 366 before we really get to a spot where it's ready to break out bullishly. So my problem with this is that it's kind of a murky trade. You need it. Oh, so you need it below 369 by Friday. I don't know. It's hard to say. If the Nasdaq continues to break out, then this thing's going to test 369 to 370. If the Nasdaq stalls out, then this will probably fall below it. Right? I can't tell you for sure. I really don't know. It really depends on the market. That is a pretty critical level. And I think if it gets to there, it's probably going to stall. So it's a roll of the dice. I wouldn't necessarily get out yet, but I would definitely have my finger on the trigger, depending on what the market does in the near future on it. Okay. Nope, unfortunately. All right, guys, that covers it for today. I appreciate the participation. If I missed one, we had a lot of stuff today. If for some reason I skipped over a name, ask me on Twitter or ask me, email me or ask me in the chat, and I'll try to get to it for you guys. There was a lot of stuff here, and I hope I got it all. Hope you have a good rest of this week. Keep an eye on what we do and how these two pairs of indices behave, and see which one ends up winning out, whether it's the SPY and the Nasdaq or whether it's the Dow Jones and the Russell. Other than that, have a good rest of the week, and we'll meet again next Wednesday.